What transpired in the silver markets this past weekend may represent the most consequential development in decades. A tariff announcement that appeared routine on the surface, yet beneath it lies a mechanism so explosive, so structurally disruptive, that 98% of market participants are missing its true implications entirely. Bullion banks are now trapped. Physical metal is stranded in U.S. jurisdiction, and the timeline for what analysts are calling a generational wealth transfer event has just been dramatically compressed. The question isn't whether silver reaches $100, $200, or beyond. The question is, how fast? Welcome to Cash Tale, where we decode the economic shifts that matter most to your financial future. If you've built your wealth through decades of business decisions, if you understand that real opportunities aren't shouted from rooftops but whispered in market disruptions, then you're in the right place. We ask just one thing: hit that subscribe button, not for algorithms, but because missing critical developments like what we're about to reveal could cost you more than just an opportunity. And before we begin, we're curious, from which corner of the world are you watching this analysis today? Drop your location in the comments. Let's see how global this audience truly is. Now, let's examine exactly what happened this weekend and why it changes everything. Over the weekend, President Trump issued an announcement that sent shockwaves through global financial markets, though most observers failed to grasp its true significance for precious metals. The declaration was direct and unambiguous. Beginning February 1st, 2026, 8 European Union nations would face 10% tariffs on all goods imported into the United States. The targeted countries, Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland, were being penalized for their opposition to America's proposed purchase of Greenland. The statement left no room for interpretation. These tariffs would remain in effect until a complete agreement for Greenland's acquisition was reached. More significantly, the tariff rate would escalate to 25% on June 1st, 2026, if negotiations failed to produce results. Initial market reactions ranged from confusion to dismissal. Financial analysts questioned the relevance of European tariffs to silver markets. After all, the European Union does not rank among the world's major silver producers. Mexico and Latin American nations dominate global production. Why would import taxes on European goods matter for a metal primarily mined elsewhere? This represents precisely the kind of surface-level analysis that causes sophisticated investors to miss transformational market developments. The significance of Trump's tariff announcement has nothing to do with European silver production. The catalyst brewing beneath this policy decision operates through an entirely different mechanism, one that threatens to destabilize the carefully managed physical precious metals market that bullion banks have controlled for decades. Throughout the first quarter of 2025, major bullion banking institutions executed a massive defensive maneuver. Dozens of millions of ounces of physical silver were transferred from the London Bullion Market Association vaults across the Atlantic to United States depositories. This unprecedented movement of metal was driven by mounting fears that the incoming Trump administration would implement sweeping import tariffs. The strategy appeared prudent at the time. By positioning substantial silver inventory on American soil before any tariff barriers materialized, these institutions believed they were protecting their ability to serve U.S. markets and maintain their position management capabilities. Fast forward to January 2026, and the landscape has shifted dramatically. The London Bullion Market Association now faces a critical shortage of physical metal. The very silver that was defensively relocated to New York during early 2025 is desperately needed back in London to satisfy delivery obligations and cover increasingly exposed short positions. Here lies the trap that Trump's announcement has sprung on the bullion banking sector. Despite understanding for the past 6 months that critical minerals would likely receive exemptions from any Section 232 tariff review, the bullion banks hesitated. They refused to move billions of dollars worth of metal back across international borders without absolute regulatory certainty. The stakes were too high, the positions too large, the potential complications too severe. Then came the moment these institutions had been waiting for. The Section 232 review concluded. Critical minerals appeared safe from tariff inclusion. The path seemed clear for rebalancing their global inventory positions. Market observers monitoring COMEX warehouse data witnessed the immediate response. Silver began leaving American depositories in substantial quantities. The metal was clearly being prepared for transport, most likely destined for London to address the mounting physical shortage at the LBMA. The bullion banks believed they had navigated the tariff threat successfully. They thought the window for freely moving inventory had reopened. They assumed they could continue managing physical tightness across global markets using the same strategies that had worked for decades. Trump's weekend announcement shattered that assumption instantly. Consider the impossible position now facing these institutions. London desperately needs physical silver. New York has that silver available, but pulling metal out of the United States to relieve European shortages now carries catastrophic financial implications. Any silver removed from U.S. jurisdiction cannot return without paying Trump's tariffs, not the 10% rate effective February 1st, and certainly not the 25% rate taking effect June 1st if Greenland negotiations stall. For institutions operating on compressed margins while managing enormous leverage positions, absorbing a 10 to 25% tariff on reimporting metal becomes financially impossible. The mathematics simply do not work. They cannot accept those terms. The practical effect is clear and immediate. Import tariffs on European Union nations have become a mechanism for trapping precious metals within United States borders. The bullion banks spent years playing what market participants call whack-a-mole with physical shortages, moving inventory between London, New York, and Shanghai to manage tightness wherever it emerged. That game just ended. The most critical artery connecting the world's two largest precious metals trading centers has been severed. The silver sitting in COMEX warehouses is now effectively immobilized, and the implications are only beginning to unfold. What happened before Trump's tariff announcement already qualified as extraordinary. What comes next may prove historic. Silver's price trajectory since breaking decisively above its 2011 high has defied conventional technical analysis and caught even seasoned precious metals traders completely off guard. The rally delivered an astonishing 83% gain in just 2 months, but the manner of that ascent matters far more than the percentage itself. This was not the measured, consolidating advance that chart patterns typically suggest following major resistance breakthroughs. Instead, silver moved in what traders describe as a nearly vertical line. The kind of price action that leaves careful investors who waited for confirmation watching from the sidelines, paralyzed by the psychology of chasing a market that already appears overextended. Here lies the paradox now facing business professionals, evaluating silver as a strategic asset allocation. Buying at current levels feels significantly more dangerous than it did before the breakout occurred. The human instinct warns against purchasing assets that have already doubled. Risk management principles suggest waiting for pullbacks that provide better entry points. Yet market analysts, emphasizing this perspective, may be fundamentally misunderstanding what type of event is actually unfolding. As this silver repricing continues to accelerate, the price behavior is not going to become more orderly or predictable. It will become increasingly chaotic and aggressive. The parabolic nature of recent moves is not a technical malfunction requiring correction. It represents the market behavior of an asset that has been systematically suppressed for decades, finally breaking free from those constraints. For investors already holding positions, this represents exactly the confirmation they have been waiting for. For those still on the sidelines, the window for a strategic entry at reasonable valuations is closing faster than traditional analysis suggests possible. Then came something unprecedented in modern precious metals markets: direct intervention from the United States government itself. In recent statements, that should have dominated financial news coverage. The White House, minerals, Czar made declarations that fundamentally alter the investment thesis for silver and the entire mining sector. The quote deserves to be read carefully and understood completely. In the next few years, the United States government will deploy hundreds of billions of dollars of capital into the mining sector. Not millions, not tens of billions, hundreds of billions of dollars, but the financial commitment represents only part of this paradigm shift. The operational approach being described breaks entirely with historical government policy towards strategic resources. The official elaborated further. We are doing things the American government has never done before, like equity investing. This is not rhetoric about loan guarantees or regulatory support. The United States government is preparing to take direct equity positions in mining operations. They are discussing stockpiling critical minerals at scale. They are holding daily conversations about protecting domestic mines from artificially suppressed prices caused by state-sponsored market interference. Mining project approval processes that historically required years are being compressed into months. Regulatory frameworks that created insurmountable barriers for decades are being systematically dismantled. And here is where this government intervention connects directly to the investment opportunity Trump's tariff policy just amplified. At the end of 2024, silver received formal designation as a United States critical mineral. That classification was not symbolic, it was not political theater. It fundamentally changed how the federal government views silver's strategic importance to national security and economic competitiveness. When the White House Minerals Czar discusses deploying hundreds of billions in capital, when equity investments are being planned, when stockpiling and price protection mechanisms are being developed, silver is included in that framework. For anyone holding silver or silver mining equities, the United States government has effectively become a partner in ensuring asset appreciation. This represents the kind of structural, strategic support that creates sustained multi-year bull markets rather than speculative trading opportunities. Now connect these developments to Trump's weekend tariff announcement. The United States government has declared silver a critical mineral. They are committing unprecedented capital to the sector. They are implementing stockpiling and price protection policies. And now, whether through deliberate strategy or fortunate coincidence, Trump's tariffs have created conditions where physical silver is being trapped on American soil, unable to flow freely to relieve shortages in Europe. If a policy team were explicitly designing a framework to engineer a silver price explosion, the blueprint would look remarkably similar to what is actually unfolding. The convergence is almost too perfect to be accidental. Gold to silver ratio analysis provides additional context for understanding where prices may be heading. Market technicians, tracking this metric note movement toward the lows witnessed between 1998 and 2011, approximately 32 ounces of silver to 1 ounce of gold. Many analysts believe the ratio will not stop at that level. Expectations center on a decisive break below 30, even if temporarily, as silver dramatically outperforms gold during the most explosive phase of this repricing event. The mathematics become almost difficult to believe when this ratio projection is combined with widely discussed gold price targets. Serious market observers are anticipating gold reaching $6,000 per ounce by April 2026 at the latest. Some suggest that timeline may prove conservative given current momentum. When a gold to silver ratio of 30 or below is applied to a $6,000 gold price, the calculation translates into silver trading at $200 per ounce or higher. $200 per ounce silver, based on the tariff disruption, the government support, the supply deficits, the technical breakout, and the ratio dynamics. This projection is beginning to look less like speculative optimism and more like mathematical probability. For investors who accumulated silver while broader markets ignored it, this repricing represents potential returns exceeding 566% from current levels. And those calculations use relatively conservative ratio analysis without accounting for the possibility that silver outperformance could push the ratio even lower during peak momentum. Some analysts are making even more aggressive near-term calls. Statements are circulating, suggesting a substantial probability that silver could reach 100 per ounce as soon as next week. Whether that specific timing materializes or not, the fact that credible market observers are making such projections reveals everything about the momentum shift and sentiment transformation happening in real time. The precious metals complex is not preparing to reset. It is resetting right now, and silver is positioned to be the biggest winner. There exists a fundamental question that exposes the true nature of what is happening in silver markets right now. The question is not why silver is moving so aggressively. The question that should be keeping market participants awake at night is, why did it remain suppressed for so long? Silver has appreciated over 140% in the past year alone. Yet analysts with decades of experience in precious metals markets are emphatic that the actual rally has not yet begun. This may sound like promotional exaggeration until one examines what is happening in the physical market, where price discovery reveals truths that paper markets desperately try to conceal. The United States Mint has quietly repriced silver eagles to $173 per ounce. Not the spot price visible on financial terminals, not the futures price traded on COMEX. The actual price charged by America's primary government issuer of silver coins stands at $173, nearly double what paper markets claim silver is worth. Consider what this pricing reveals. When an entity needs to acquire and deliver physical silver, when inventory must actually exist rather than simply appear as a ledger entry, the real cost becomes visible. The disconnect between paper prices and physical reality has never been wider, and that gap is about to close, violently. The fundamental issues driving this crisis are not speculative theories. They are mathematical certainties that can be verified through production data and industrial consumption statistics. First, global mine production of silver peaked in 2016. Since that year, total annual output from mining operations worldwide has been in decline. This is not a temporary fluctuation. This represents a structural turning point. Every year that passes, humanity is extracting less silver from the earth than the year before. Second, demand for silver is accelerating at an unprecedented rate. Solar panel manufacturing alone is consuming silver at levels that were inconceivable a decade ago. Artificial intelligence infrastructure requires silver in countless applications. Electric vehicle production demands silver. 5G telecommunications networks demand silver. Every technological advancement that defines the modern economy is draining silver reserves at record speed. Third, and perhaps most critically, the global silver market is now in its 5th consecutive year of supply deficit. Production plus recycled supply does not equal consumption. The gap between what the world needs and what the world can produce grows larger each year. Industrial users and investors attempting to acquire physical silver are now experiencing delivery delays ranging from 6 to 12 months. This is not a temporary supply chain disruption that will resolve itself. This is structural shortage becoming more severe with each passing quarter. And now, on top of all these existing pressures, Trump's tariff policy has just made it exponentially harder for bullion banks to move physical silver to where it is needed most. Consider the timeline of fundamental deterioration. Peak production occurred in 2016, 8 years ago. Since then, accelerating industrial demand has collided with declining output. The deficit has compounded year after year. The United States government has formally recognized silver as a critical mineral. Washington has committed hundreds of billions in capital to securing domestic supply. The technical breakout has already delivered 83% returns in 2 months. And now a tariff regime has been implemented that traps inventory and prevents the free flow of metal between the world's largest trading centers. If this were a single factor, markets might adapt. 2 or 3 factors, prices would adjust accordingly. But when every fundamental variable, supply, demand, government policy, technical structure, physical market infrastructure, and geopolitical disruption all point in the same direction simultaneously, the result is not a typical bull market. It is a market structure failure. It is a repricing event. Here's where long-term projections begin to sound almost absurd until one examines the mathematics behind them. Silver analysts are now openly projecting prices between $400 and $1,000 per ounce within the next 4 years. These are not fringe voices making sensational predictions for attention. These are serious market observers examining supply deficit curves, industrial demand growth rates, monetary policy trajectories, government intervention programs, and tariff disruption effects, then concluding that current prices represent a fraction of where silver must trade to reflect actual scarcity. The $173 price the U.S. Mint is charging for silver eagles may not be inflated. It may be the beginning of honest price discovery. But even these projections fail to capture the most startling aspect of silver's fundamental scarcity. There exists a simple mathematical reality that puts everything into proper perspective, and it is a calculation that cannot be disputed or dismissed through market manipulation or paper contract creation. Approximately 8 billion people currently live on this planet. Meanwhile, the total amount of silver available above ground, all of it, everywhere, in vaults and jewelry and industrial applications, in coins and bars, amounts to roughly 4 billion ounces. The mathematics are brutally simple. That equals exactly 0.5 ounces per person on Earth. Half an ounce. 1/2 of a single ounce of silver exists for every human being alive today. This is not economic theory. This is not speculative analysis. This is pure arithmetic revealing that silver ranks among the rarest monetary metals on the planet, rarer than gold when measured by above-ground availability per capita. And now, thanks to Trump's tariff announcement, a significant portion of that already scarce above-ground supply has been trapped in the United States. It cannot flow freely to relieve critical shortages in London. It cannot be deployed where bullion banks need it most. The small amount of silver that exists cannot move to where demand is highest without triggering massive tariff penalties that make such movements economically impossible. For decades, bullion banks maintained the illusion of abundance through paper contracts and creative position management. They moved physical inventory strategically to suppress price wherever tightness emerged. That game required one critical element to function: the ability to move metal freely across borders without prohibitive costs. Trump's weekend announcement eliminated that critical element. The physical market infrastructure that allowed price suppression for decades has been fundamentally disrupted. And unlike previous disruptions that could be managed through regulatory intervention or coordinated central bank action, this disruption stems from trade policy designed to achieve completely different geopolitical objectives. The bullion banks cannot negotiate their way out of this. They cannot lobby their way out of this. They cannot use traditional market manipulation techniques to resolve a problem rooted in international tariff policy connected to Greenland acquisition negotiations. The supply deficit that has been building for 5 years, the industrial demand that accelerates with every technological advancement, the government intervention that now treats silver as strategic infrastructure, and the tariff barriers that now prevent physical rebalancing between continents. These are not temporary factors that will fade when market sentiment shifts. These are the new structural realities of the silver market, and the implications are only beginning to be understood. If this were a single factor, markets might adapt. 2 or 3 factors, prices would adjust accordingly. But when every fundamental variable, supply, demand, government policy, technical structure, physical market infrastructure, and geopolitical disruption all point in the same direction simultaneously, the result is not a typical bull market. It is a market structure failure. It is a repricing event. Here's where long-term projections begin to sound almost absurd until one examines the mathematics behind them. Silver analysts are now openly projecting prices between $400 and $1,000 per ounce within the next 4 years. These are not fringe voices making sensational predictions for attention. These are serious market observers examining supply deficit curves, industrial demand growth rates, monetary policy trajectories, government intervention programs, and tariff disruption effects, then concluding that current prices represent a fraction of where silver must trade to reflect actual scarcity. The $173 price the U.S. Mint is charging for silver eagles may not be inflated. It may be the beginning of honest price discovery. But even these projections fail to capture the most startling aspect of silver's fundamental scarcity. There exists a simple mathematical reality that puts everything into proper perspective, and it is a calculation that cannot be disputed or dismissed through market manipulation or paper contract creation. Approximately 8 billion people currently live on this planet. Meanwhile, the total amount of silver available above ground, all of it, everywhere, in vaults and jewelry and industrial applications and coins and bars, amounts to roughly 4 billion ounces. The mathematics are brutally simple. That equals exactly 0.5 ounces per person on Earth. Half an ounce. 1/2 of a single ounce of silver exists for every human being alive today. This is not economic theory. This is not speculative analysis. This is pure arithmetic revealing that silver ranks among the rarest monetary metals on the planet, rarer than gold when measured by above-ground availability per capita. And now, thanks to Trump's tariff announcement, a significant portion of that already scarce above-ground supply has been trapped in the United States. It cannot flow freely to relieve critical shortages in London. It cannot be deployed where bullion banks need it most. The small amount of silver that exists cannot move to where demand is highest without triggering massive tariff penalties that make such movements economically impossible. For decades, bullion banks maintained the illusion of abundance through paper contracts and creative position management. They moved physical inventory strategically to suppress price wherever tightness emerged. That game required one critical element to function: the ability to move metal freely across borders without prohibitive costs. Trump's weekend announcement eliminated that critical element. The physical market infrastructure that allowed price suppression for decades has been fundamentally disrupted. And unlike previous disruptions that could be managed through regulatory intervention or coordinated central bank action, this disruption stems from trade policy designed to achieve completely different geopolitical objectives. The bullion banks cannot negotiate their way out of this. They cannot lobby their way out of this. They cannot use traditional market manipulation techniques to resolve a problem rooted in international tariff policy connected to Greenland acquisition negotiations. The supply deficit that has been building for 5 years, the industrial demand that accelerates with every technological advancement, the government intervention that now treats silver as strategic infrastructure, and the tariff barriers that now prevent physical rebalancing between continents. These are not temporary factors that will fade when market sentiment shifts. These are the new structural realities of the silver market, and the implications are only beginning to be understood. The tools that allowed position management for decades are no longer available. Physical silver cannot move between continents without triggering tariffs that destroy the economic viability of the trades. The first structural disruption of this magnitude in modern precious metals history is unfolding in real time, and the institutions that have controlled these markets have no clear path to resolution. Market experts emphasizing the significance of this moment are not engaging in promotional hyperbole. They are recognizing that a 40-year base formation has broken out, that supply constraints building since 2016 production peaks are intersecting with exponentially accelerating industrial demand, that monetary debasement has been relentless since 2008, that government policy has shifted from passive observation to active intervention, and that tariff disruption has added an immediate catalyst that potentially accelerates the entire supercycle timeline. The question facing the business community is not whether silver will appreciate. The mathematics and structural factors make that outcome highly probable. The question is whether strategic positioning occurs before consensus understanding develops, or after prices have already moved beyond comfortable entry points. Analysts characterizing this rally as just beginning are not making speculative predictions. They are observing that physical market disruption of this magnitude cannot be easily resolved, that bullion banks cannot quickly adapt to losing their primary position management tools, and that the timeline for what was already anticipated as a multi-year repricing event has potentially been compressed by geopolitical developments completely outside the precious metals sector. Some market observers are suggesting substantial probability exists for $100 silver as soon as next week. Whether that specific timing materializes or not, the very fact that credible analysts are making such statements reveals the momentum shift and sentiment transformation occurring in real time. But let us be precise about what this represents for serious investors and business professionals evaluating strategic asset allocation. This is not a speculative trade based on technical momentum or sentiment extremes. This is fundamental market structure change driven by factors that cannot be quickly reversed. Tariff policy is connected to Greenland negotiations, not silver market management. Government critical mineral designation and capital deployment programs are multi-year initiatives, not quarterly policy adjustments. Supply deficits that have compounded for 5 consecutive years do not resolve through short-term production increases. Industrial demand driven by solar manufacturing, artificial intelligence infrastructure, and electric vehicle production continues accelerating regardless of price. The bullion banks are trapped. The physical metal is trapped. The timeline has been compressed. And every major factor driving asset valuation points toward the same outcome. For investors who have been systematically accumulating silver while broader markets focused elsewhere, this convergence represents validation. For those who have been observing from the sidelines waiting for clearer signals, the signals have now been delivered with unusual clarity. The silver supercycle is not approaching. It is not anticipated. It is not projected for some future quarter. It is happening right now. Trump's tariff announcement did not create this supercycle. The fundamental factors were already in place. But what the tariff policy has done is remove the release valve that allowed bullion banks to manage physical tightness through strategic inventory movement. It has accelerated a timeline that was already compressing. It has thrown gasoline on a fire that was already burning hot. Market experts are emphatic that the rally has just begun. Physical market dynamics suggest the best performance remains ahead. The most explosive move in precious metals history may be unfolding over the coming weeks and months. This is not entertainment content. This is not motivational material. This is strategic economic warning for decision makers who understand that generational wealth transfer events are recognized by those who act, not by those who wait for confirmation that never provides comfortable entry points. The convergence is complete. The catalyst has been delivered. The market structure has been fundamentally altered. What happens next will be determined by how quickly consensus understanding develops, and whether strategic positioning occurs before or after prices reflect the new reality. The business community now faces a straightforward choice. Recognize structural convergence while it is still developing, or explain in retrospect why the signals were missed.